Dr. Bernanke, I want to talk about the aftermath and the regulatory environment. Sure. The financial services industry has changed completely. A number of, lending, now a lot of lending going to other areas, not the traditional banks. Are you happy with what has taken place in terms of the financial services industry? Is this what you expected?
Well, I think a lot of progress has been made. We had a terrible crisis. We had to take some strong steps, and I think the system is a lot stronger now, and I would point specifically to capital. Banks have a lot more capital. They have to be stress tested. Big banks have to hold more capital than other banks. They have to hold loss-absorbing capacity in terms of bonds that can be converted to capital. So there's a lot more buffer now, and that's really good. Now, there are lots of things going on. I mean, one issue that you're alluding to is that some of the lending is moving out of the banks into what we have called the shadow banking system, other parts of the system. That requires, close attention, and I know the Fed is looking at that very carefully. But I think, broadly speaking, the Dodd-Frank and the Basel III changes were positive.
What about, the argument that a Jamie Dimon might have? He wrote about it, obviously, in his annual report, that, look, with these moves to force the banks to hold so much more capital, the banks will have less wiggle room if, in fact, the market needs liquidity because we're holding all of this capital.
Well, there's trade-offs everywhere, right? And they complain that higher capital requirements increase their cost of funding, at least in terms of their total overall cost. But again, we had a terrible crisis, and we sure don't want to repeat that. And having a stronger banking system, in the end, the U.S. banking system right now is very competitive in the world, and moving into areas where other banking systems are not weak enough, are too weak to compete. So I think overall, our system is doing quite well.
Very competitive in the world, and yet when you look at some of the Asian banks, even European banks, they're not under the same exact, rulemaking that the U.S. banks. And so the bankers today might say, it's not competitive because we're at a disadvantage.
Well, it's not exactly the same, but, most of the capital rules, for example, were internationally agreed and are being implemented globally. And the Fed, by the way, has, stepped up and made sure that subsidiaries of foreign banks that operate in the U.S. have to follow the same rules as U.S. banks. So there is much more of a level playing field than there has been in the past.
Dr. Bernanke, how would you characterize the U.S. economy today?
I think it's improving. It's moving forward at a moderate pace. It would be nice if it was stronger, but we've sure come a long way. I mean, in 2009, the unemployment rate was 10%. Today, it's 5%. We've had, 6 years of growth. Again, a stronger economy would be better, but we have certainly made a lot of progress, and we're doing well compared to other industrial countries as well.
What is holding the U.S. back? I mean, we've got CEOs that come on the program. They talk about the regulatory environment. They talk about Obamacare, and that is sort of putting them in a corner, unwilling to hire new people. And then they're also talking about just a slow demand story from the global story.
Yeah.
What are you expecting that's holding us in check?
Well, yeah, in the near term, I think that the domestic U.S. economy is moving along pretty well. The housing sector is coming back, a lot of jobs being created. I think the drag we're seeing right now is coming mostly from the international economy.
Okay, so the global story includes China, includes the emerging markets, and of course Europe, which is slow at best.
Yes, correct.
So how bad is the Chinese story? How impactful is China and emerging markets?
Well, it's interesting because in August, the markets got all jumbled up over Chinese developments. China's slowdown was something that has been anticipated for a long time. They have to transition from this 10% growth rate to a more sustainable lower growth rate, so we knew that was going to happen. But I think what's happening is that, to some extent, the emerging markets that trade with China or depend on commodity exports are finding it harder to adjust to that slower growth in China than was anticipated.
I know it's a big deal going from 11% to 5% for China, but I mean, should we really focus on that so much, given the fact that the exports are not that substantial, the U.S. going to China?
That's right. The direct effect of China on the U.S. is not that great. Our exports to China are not that large, and in addition, when China slows, generally commodity prices go down, which on net are probably good for the U.S. because we import a lot of raw materials. So China's slowdown in itself is not that much of a problem, but to the extent that emerging market economies from Brazil to Russia, are having problems because of commodity prices and because of their trade with China, that affects us through financial markets and other ways.